I'm Ryan Lightfoot-Brown of FundCalibre. We're joined today by Mark Hammonds, manager of the elite-rated Guinness Asian Equity Income Fund. Thanks for joining us.
Thank you.
Mark, could you just explain to us your investment process?
Sure. So the process by which we run the Guinness Asian Equity Income Fund is we start by looking for quality companies, and we have a very specific definition of what it is to be a quality company. We look for companies with sustained competitive advantages over their peers. And the way we measure those competitive advantages is by using return on capital. We look for companies that have a history of high returns on capital that have been sustained over time. So in Asia, we look for companies that have a real return on capital of at least 8% for each of the past 8 years. So companies have to have that 8-year track record, first of all, and secondly, they have to have been consistently profitable over that time frame. And there are around 1,900 companies globally that have achieved that, and of those, 500 of those are in Asia. So we think it's a good place to find those types of companies. Next, we filter out those that are highly geared, that have high levels of debt, and those that have very small market caps, and that leaves us with an investment universe of 300 companies. We then look at valuations, so we look to say within that universe of 300 quality stocks, where can we find stocks that are being mispriced by the market. So where are there opportunities where the market is undervaluing those companies' future cash flows? And then the final part of the investment process is to look at the dividend. And this is quite deliberate. We specifically look at the quality of the company first so that we can be confident that that company has the ability to generate cash in order to pay the dividend. And secondly, these companies often have very good opportunities for reinvestment as well because they're returning, they have high returns on capital. So we look for companies that have the ability to reinvest and grow their dividend over the long term. So it's that dividend growth that is something that we look for in the fund.
And rather unusually, you have equal weightings for all of your holdings in your portfolio. Can you just explain to us as to why you do that?
Yes, so it's partly a house style. But we believe it focuses our efforts very much so on the stock selection part of our investment process. We have 36 stocks in the portfolio, all equally weighted, as you say. That 36 is a fixed number, so if we want to buy another position to add to the fund, we first have to sell something that we hold already, so we keep that discipline. And secondly, by equally weighting, we are confident in our ability to predict undervaluations and valuation opportunities in the stocks that we're looking at. What we can never be as sure of is when those valuation opportunities, when those valuation discrepancies rather, will close. So rather than trying to shift our bets between the stocks, we keep them all equally weighted. We have a discipline for rebalancing the portfolio to bring those stocks back into equal weight. So when stocks have done very well, we can take our profits and add those into the stocks that have lagged. And over time, we think that harvests volatility and can add a little extra to our returns.
And one of the more interesting stories about Asia in 2018 is the plight of the tech stocks. Do you think their movement is a sort of a long-term trend, or 2018 was a bit of a one-off?
Yeah, I think that we see this quite often with the tech stocks that we hold, is that they go through periods where the market feels more optimistic about them and periods where the market is slightly more pessimistic about them. One of the sort of areas of IT stocks, and within the IT stocks there are obviously different sort of sub-industries. One of the types of companies that we own is component manufacturers that produce components for smartphones. Now, obviously, they can have a varying degree of exposure to Apple, and depending on how Apple iPhone sales look at any one time, those stocks can be either treated well or treated less well by the market. But the stocks we own, quite often the common element between those stocks is that they have very strong competitive positions. So they have niches in which they operate, and quite often they are the market leader. So at any one time, if you get times when the market is feeling more pessimistic, this can actually be a good opportunity to buy into those stocks at attractive valuations. And because they've had this history of earning consistent returns on capital, you can be confident that the company is likely to continue earning those returns into the future. So actually, when you get periods where you have slightly weaker numbers in some of these stocks, actually you can build a position in some of these companies and you can do very well over the long term.
And aside from sort of tech that you've mentioned, where else are you finding the opportunities at the moment?
So generally we tend to find better opportunities in North Asia, so in China, in Hong Kong and Taiwan. Korea is perhaps the exception. We find it harder to get that combination of quality, attractive valuations and dividend, and particularly dividend growth that we look for.
Mark, should investors be concerned about trade wars and the impact it will have on China?
Yeah, it's obviously a very topical issue at the moment, and what we've seen recently is sort of a ceasefire in the trade conflict. The way we approach it is to step back and take quite a long-term view and say what's been happening in China over the past 10 or 20 years. And actually we see a country that has transformed in terms of its manufacturing capabilities and so on. And the way that China has developed is by moving and shifting from being a manufacturer of very simple, non-complex goods sort of 15 or 20 years ago. It was producing textiles, footwear, other clothing and so on, very simple goods to manufacture. China is still producing those goods, but increasingly it's become a manufacturer of more sophisticated and more complex goods. Now the number one export from China is computers. It's producing other consumer electronics, smartphones, industrial machinery. It's developed strong capabilities in automobile manufacture. So if you look at these trends and how they have evolved over a long period of time, we think this is something that's very much likely to continue in the future. There have been some disruptions in the short term relating to trade. I think the biggest impact it has had so far has been on uncertainty and making sentiment quite negative towards China in the markets. Actually, we feel that China is on this long-term path, and it's going to be very difficult for that to be derailed substantially in the short term.
Okay. Well, Mark, that's really interesting. Thank you very much for joining us.
Thank you.
For more information on the funds, please visit FundCalibre.com.